Let's understand about financial statements. Financial statements are set of statements through which we can understand the financial position of a company. I can say that in order to understand the financial health of a company, that is how the company is performing financially, we must gain knowledge about the financial statements. There are five components of financial statements in general. First one is balance sheet. Second one is income statement. Third one is cash flow statement. Fourth one is statement of changes in equity. And the fifth one is explanatory notes. Now, what are these five statements? Let me brief out. Balance sheet is the face of a business. That means if you want to know whether the business is running well, whether the business is solvent, whether the business has a future, then the document through which you can understand it, that is the balance sheet. Balance sheet is a statement of procurement and application of funds. Procurement means from where the business got the money, and application means where the money have been invested. Now, what are the different sources from where the business get money? First, the owners of the business put money, that is known as the equity contributed by the owners. Then through its running, business earns some profit, business earns some earnings. These are known as the reserves and surplus. Reserve means which is kept for use in future, maybe for general use known as general reserve, or maybe for a specific purpose, that is special reserve. But surplus means the balance in profit and loss account which is available for use any time at the discretion of the management or board of directors of the company. This is the difference between reserve and surplus. So initially the owner contribute money, that is known as the equity capital. From the business, the profit earned is kept in the name of reserve and surplus. Then bank may borrow the money from banks, financial institutions. May the company procure money from the public or from some private people in the name of public debt, debentures, bonds, etc. These are known as the debts or loans for the business. So these loans can be used for the long-term purposes. So they are known as the non-current loan या फिर long-term loan. And there is current liability, that means fund raised or fund kept for immediate use for the running of the business. For example, raw material procured from suppliers but payments have not been made, they are known as the sundry creditors. Maybe some expenses have been incurred but the payment has not been made, those are known as the expenses outstanding. And there may be some salary outstanding, there may be anything which is payable immediately or within a very short span of period. Similarly, business get loan from the banks for short-term use. These are of two types. One is cash credit, second is overdraft. Cash credit is for trading, manufacturing organizations where such business houses keep their stock hypothecated before the bank and get some loan and get some limit for use. Interest will be payable only to the extent the cash credit is utilized. But overdraft is basically applicable for service providers where you keep fixed deposits or properties mortgaged before the bank and bank gives you a sanction limit, just like credit cards. The sanction limit may be 10 lakhs, but suppose you have utilized up to 2 lakhs, you have to pay interest only on 2 lakhs. When you get the money, you can put the money in the cash credit or the overdraft account so that you can manage your loan and you can minimize your interest. So this is all about the sources of fund, that is equity, loans, reserves, surplus and current liabilities. Now where these money are parked or invested, these are invested in assets. The assets are long-term assets or maybe short-term assets. Long-term assets are those assets on which huge investment are made in the initial year but return is expected over a period of time. For example, you have invested the money in building, land, or you have invested the money in plant and machinery. So there may be huge investment in the initial year, but upon their use, you will get return over the period of time, over a period of time. So they are going to give you enduring benefits. That means benefit for more than 1 year. So these are known as long-term assets or fixed assets. So the fixed assets need to be written off over their useful life. That means over the year through which they are expected to generate revenue for the business. So they are written off over their useful life in the name of depreciation. So fixed assets normally call for depreciation which are charged against the profit to find out the real profit of the business. Now, why depreciation is counted? Depreciation is counted just to identify the real profit. In the books, you are making profit, but if you are not counting the depreciation, that necessarily means that you are not counting the loss or the expenses you are incurring out of the use of the capital assets. So, depreciation need to be counted. That is very, very important. Similarly, there may be some expenses which are not giving you any fixed asset, which are not giving you any long-term asset, but they are going to give you future benefits. That means benefits over a period of time. For example, in the initial time of your business, you have made huge advertisements, huge marketing. So these marketing or advertisement expenses are going to give you return or benefit over maybe 2 years, 3 years or 4 years or 5 years. So these expenses need to be written off over 5 years, not necessarily within the year in which they have been expended. For example, in the initial year, you will not going to get profit, or maybe the profit will be less. But due to these advertisement and marketing expenses, the profit will be high in the future. So these expenses need to be amortized over a period during which they are expected to bring benefit to the business. This is known as amortization. This is the difference between depreciation and amortization. So you need to understand what is depreciation and what is amortization. Depreciation is on physical fixed assets, but amortization is on those deferred expenses. That means the expenses which are huge in nature in the initial year, but they are expected to bring benefit over a period of time. Okay, so you have to categorize it. Similarly, assets may be categorized into tangible assets and intangible assets. What are tangible assets? Tangible assets means assets those have physical existence, like as I said, land, building, plant, machinery, etc. But intangible assets are assets, but they do not have any physical existence. Like the software you have developed, you may have expended 25 lakhs, you may have expended 25 crores. But this benefit of the software will come to the business over years. So it need to be written off over those years. Normally we charge depreciation at the rate of 25%, but it is to be written off over the period during which it is going to bring benefit to the business. Similarly, you are gearing up business over a period and you are generating a brand for the business. You are generating a goodwill for the business. That is a intangible asset. Brand, goodwill, all these are intangible assets. Similarly, your logo that is registered, your trademark, all these things are intangible assets. They need to be depreciated over a period of time. Okay, so tangible assets, intangible assets and fixed assets, that means non-current assets or long-term assets. Similarly, the application may be in the short-term ledger. For example, you have sold goods, but you have not received the money. The money is expected to be received after 3 months, 6 months or 5 months. Okay, these are known as receivables or sundry debtors. Okay. Similarly, you have short-term money in the bank in the current account. It is a what? Current asset. Similarly, you have made investment in the capital market which are liquid in nature. That means anytime you need, you can withdraw the money by liquidating the investments. Okay, so these are also current assets. But if you are making long-term investments, say for more than 1 year, that is a non-current investment, and this is known as non-trade investment because this investment is not made in the business. The investment made in the business may be fixed asset, maybe intangible assets, maybe tangible assets, whatever it may be. But investment made not necessarily in the business, that is known as non-trade investment. So you have to categorize this like this. Okay, so current assets and current liabilities are the living blood of the business. Due to this, your business is running smoothly on day-to-day basis. But non-current assets are going to bring the business are going to bring benefit to the business over a period of time, what we call as enduring benefit to the business. So this is all about balance sheet. Okay, this is a brief discussion on balance sheet. For detail, we'll look forward. Okay, thank you. In the next video, I will talk you about income statement. Thank you. Have a good day.